morning, everyone, and welcome to KBRA's inaugural BDC webinar. Thank you for listening in. My name is Caitlin Colvin, and I'm a Managing Director in the Business Development Group here at KBRA with a focus on investors. For those of you who may not be aware, KBRA is a global rating agency with more than 350 employees and 4 offices. Globally, we've rated over 2,000 issuers and transactions. I'm joined by Marjan Riggi, Senior Managing Director and Head of KBRA's Commercial Finance Ratings Group, and also I'm here with her team, which includes Teri, Seelig, a Director, and Boris, Alishayev, also a Director. Marjan and her team will be taking you through the webinar. The team is excited to announce their new quarterly BDC compendium that will be published on an ongoing basis. The quarterly compendium is reflective of KBRA's intent to be the most transparent rating agency on the street and is in addition to the regular research that Marjan and her team put out on BDCs. We hope the information in the compendium is useful to investors, issuers, and bankers alike. All research, including the compendium, is available free of charge on kbra.com. We will be holding time at the end of the webinar for questions. At any point during the presentation, please feel free to submit questions through the GoToMeeting, and Marjan and team will be able to respond at the end of the presentation. Without further ado, I'd like to hand it over to Marjan.
Thank you, Caitlin. Good morning, and thank you for joining our webinar. As Caitlin mentioned, I lead our commercial finance team within which we rate BDCs. To begin, I thought it's useful to do a brief history of the sector as well as our place in it. Then I'll hand over to Teri, who will talk about some of the performance dynamics, followed by Boris, who will cover leverage trends, especially in light of the ability for higher leverage for some BDCs, as well as the asset quality trends. As you can see on slide 4, BDCs have grown both in numbers and asset values by quite a bit since 2009, from a bit over 20 billion only to 100 billion at the end of last year. Interestingly, the entire sector's asset size is only a fraction of the much larger middle market leveraged loan space, which is estimated to be nearly 6 trillion. This includes numerous types of direct lending, fund-like vehicles, CLOs, and banks, as well as some private equity investments. We've seen roughly 100 billion in annual originations since 2010. But putting aside their size, BDCs provide a specific investment proposition that goes back to the Small Business Incentive Act of 1980 and was intended to stimulate growth for smaller and medium-sized private companies in the U.S. The idea was to allow a wider investor base for such assets and increase liquidity for businesses who don't have access to public equity. Essentially, BDCs allow the pooling of monies by smaller investors in search of dividend yield, who could then provide capital for private companies with less access to liquid capital. But these loans are very risky and highly levered, so the government wanted to limit risk for investors by regulating leverage levels and concentration risks for BDCs while creating an active equity market for them, which is why this is probably one of the most highly regulated investment spaces for investing in high-yielding bank loans. Even though the leverage restrictions have been relaxed since last year for some BDCs, for them to continue to have good access to equity and debt markets, they have to be vigilant as to their leverage levels and be mindful that it is appropriate for the amount of risk they take. This is also a key rating driver for us, which Teri and Boris will detail shortly. Now turning to slide 5, we've laid out the summary of our ratings coverage for BDCs and a little about how we got here. We began our ratings with the rating of Hercules Capital in 2013. We were the first agency to rate their unsecured debt. Hercules is one of the few internally managed BDCs, and its main focus is on venture-backed debt to startups active in tech and biotech industries. This was an interesting entry for us in terms of ratings, as Hercules is somewhat unique among BDCs who have a more diversified exposure to small and medium middle market companies. But since then, we have progressed to ratings of many BDCs across the credit spectrum and investment strategies. We now have a portfolio of 11 ratings, 9 of which are published and are listed here. Granted, because of the narrow band on leverage and various factors unique to BDCs, they should perform similarly, but in practice, that has not been the same. Although ours are also bunched in the BBB range, it is our view that some names are clearly stronger than others, and we try to reflect that in our ratings. Now turning to my final slide, slide 6, I want to talk a little bit more about that. We have seen that BDCs with very risky investments have fared very well because of the high quality of their underwriting and monitoring, while some with similar levels of overall risk have not. Though restrictions on leverage effectively converge the ratings of BDCs in a narrow band, we think that even then there are differences amongst them. Quality of management and underwriting, access to different pools of capital, and ability to co-invest with a larger overall platform all have had an impact on performance, which Teri will go into much detail later. Another perspective on BDCs managed by larger platforms would be that they should be better placed given their deeper access to middle market loans. But we have found that even names which are independent but have veteran management teams with deep relationships both in lending and capital markets can perform strongly. Our rating reports highlight the reasons for these differences, and we often get on the phone with investors to discuss our views on each name. We also publish lots of research, as Caitlin mentioned, both on the sector and on individual names we rate. We also be launching our quarterly compendium, which Caitlin also mentioned, where we would talk about the summary of our ratings activity as well as current trends in the industry. And it should be available shortly. And this concludes my part of the presentation. Now I hand over to Teri, who will cover some of the performance dynamics for BDCs.
Thank you, Marjan. I'm sure profitability in the age of increased leverage, a potential recession on the horizon, and the challenge of managing through a lower interest rate environment are on every BDC investor's mind. In this light, can the industry sustain dividend coverage? I will address these issues. There's no denying that the credit environment has been benign. BDC credit quality is solid as the industry has very little legacy assets remaining on the balance sheet. Revenue and earnings are strong in the U.S. middle market domestic companies, evidenced by a solid labor market, low inflation, and a stable economy. However, the possibility of a recession looms large. Hence, BDCs are positioning their portfolios defensively, underwriting more non-cyclical and defensive sectors such as healthcare. Those BDCs with approval to increase leverage are focused on underwriting loans in the higher in the capital structure, but the vast majority currently maintain leverage well below a 1-to-1 ratio as competition is aggressive, and the BDCs are unwilling to underwrite to the competitive covenant-light standards. KBRA anticipates that increased loan volume will take between 12 and 24 months given the current environment. With increased leverage, BDCs plan to grow their share of first lien investments. Thus, weighted average yield will decline, placing pressure on net interest income. Additionally, a reversal in the Fed's interest rate policy with a more dovish outlook could be challenging to BDCs as their balance sheets are asset sensitive. Most BDCs have an asset-liability mismatch with more than 90% of their investments floating rate and less than 50% of their debt floating. Few hedge their interest rate risk, instead focusing almost exclusively on credit risk. Unsecured debt is usually locked in for 5-year periods, and hence with the decline in LIBOR, the gap between investment income and cost of interest narrows. As the gap narrows, BDCs will seek to increase their investment through increased leverage to maintain dividends. So while dividends have been solid and we haven't seen many dividend cuts since 2017, we don't anticipate considerable dividend growth nor dividend cuts despite increased assets. Refer to page 8 of the slides, which shows individual BDC coverage. As you can see, coverage is solid. KBRA will continue to monitor coverage as margins compress and leverage increases. BDCs have estimated that a 100 basis point drop in rates would result in a decline in net investment income between 5% and 10%. We are also seeing several interesting developments on the cost side, which include a reduction in the base management fee to 1% of assets that are financed with debt exceeding a 1-to-1 leverage ratio. This fee reduction coincides with allowable lower asset coverage to 150% from 200% that was passed by the Small Business Credit Availability Act in March of 2018. Another trend we are witnessing is increased mergers and acquisitions activity. BDCs are merging with or acquiring other BDCs to increase scale to lower operating costs through the elimination of duplicate administrative, regulatory, and professional expenses. The larger BDCs also provide for a further diversification of assets and an increase in deal flow through larger platforms. Recent M&A announcements include FS KKR Advisor, a partnership between FS Investments and KKR Credit Advisors, signing a definitive agreement to merge 4 non-traded business development companies under its advisement. The combined company will become the second largest BDC with over $9 billion in assets on a pro forma basis as of March 31st, 2019. Also, Golub Capital BDC announced a merger agreement with Golub Capital Investment, which is expected to have $4.2 billion of assets. Some others we've witnessed in 2018 include FS KKR, a partnership between FS Investment Corp. And Corporate Capital Trust, Business Development Corporation of America through Benefit Street Partners acquiring Triangle Capital, BlackRock's acquisition of Tannenbaum Capital, and lastly, Oak Tree Capital Management taking over Fifth Street Finance Corp. You can refer to page 9 of the presentation to see how acquisitions have affected the total asset growth. KBRA remains vigilant in its analysis as we carefully weigh the possibility of an impending recession along with the industry's increasing leverage metrics. I'll now turn to Boris Alishayev, who will discuss balance sheet leverage and asset quality.
Thank you, Teri. Touching on BDC leverage, the majority of publicly traded BDCs have taken advantage to increase leverage following the passage of the SBCAA in March 2018. We estimate that 35 or 75% of BDCs tracked by KBRA have received the necessary approvals, plus reached their respective effective date to increase their debt-to-equity ratios to a maximum of 2 times, or 67% on a debt-to-total capital basis. As highlighted in the chart below on slide 11, the dates that increases in allowable leverage became effective varied by company and the process the BDCs followed. An approved leverage an approved increase in leverage became effective 1 year after board approval or the day after the shareholder approval. With that in mind, of the companies tracked by KBRA, 92% became effective by the end of the second quarter, with Ares and Apollo implementing higher leverage during the second quarter. Oak Tree Specialty and THL Credit are scheduled to become the last BDCs to increase leverage in the first quarter of 2020. BDCs have publicly stated to take measured steps to increase leverage from median leverage target of 0.75 times before the passage of SBCAA to the new leverage target range of 1 to 1.4 times. As Teri mentioned, KBRA forecasts that it will take companies 18 to 24 months to ramp up leverage to the new target, with some companies indicated it might take as long as 36 months. Main Street Capital and Prospect Capital are 2 large BDCs that have decided not to pursue higher leverage at this time, but may reevaluate in the future. Frequently, we are asked, how do we get comfortable with BDCs implementing higher leverage. While higher leverage is a credit concern, it is mitigated by a couple of factors. First, the BDC industry has evolved over the past decade, with majority of BDCs today managed by large alternative asset managers, which provide significant internal and external support. These large platforms have resources to provide extensive access to global investment network, deal flow, and larger overall bank counterparties. Very often, these large platforms have multiple publicly and private BDCs under management, as well as 1940 Act exempted relief that allows for co-investment. The next mitigating element would be the composition of the overall capital structure and the cushion between BDC's reported leverage and its regulatory limits. Over the years, BDCs have made strong effort to develop access to various capital sources, more specifically expanding and developing public and private unsecured markets. We expect higher leverage might be achieved via the issuance in the unsecured market and further transitioning BDCs toward an unsecured borrowing model. We estimate the unsecured debt issued will improve BDC's debt profiles, increase the pool of unencumbered assets, and reduce reliance of the credit facilities. Creation of larger cushions between regulatory limits and reported leverage is another positive element. KBRA expects capital cushions with respect to minimum asset coverage requirements to expand to a range of 50 to 60% for many BDCs. They have elected to transition to 150% asset coverage requirements, up from roughly 20% for BDCs with 200% asset coverage requirements. The other mitigating element would be the asset quality. As highlighted on slide 12, today the BDC sector is mostly senior secured, with a growing list of companies shifting portfolios not just towards the senior secured, but towards the first lien assets. As highlighted on the charts below, today first lien assets account for over 60% of BDC's portfolios, up from about 20% before the recession. We have a favorable view of companies rotating into lower yielding first lien assets using additional leverage, as this will reduce the overall look-through leverage, as well as reduce credit and market value risks for the portfolios. An area of concern for us is the ability to source and close on quality loans. As previously mentioned by Teri, competition for quality investments is certainly intensifying. Traditional cash flow lending is becoming too crowded. We're concerned with the number of companies pivoting towards investments in less liquid middle market investments or niche areas of the credit market. We've seen a trend of BDCs acquiring ABL platforms, as well as allocating capital towards specialty life sciences and equipment finance lending businesses. Overall, we think the BDCs are generally doing the right thing in terms of ensuring that more leverage are appropriate for both asset allocation and performance perspective. And with that, I'd like to turn the call over to Marjan.
Thank you, Boris. So this summarized our view on BDCs, and we will now open for questions. If anybody has a question, I think you can submit it. So
Okay.
we have one question. I'll read it out. As BDCs increase leverage, many have said they're going up to underwrite in the higher part of the capital structure, given that these investments are lower yielding. How will BDCs sustain their dividend coverage? Teri, do you want to take that?
Sure. Now, when we've gone out and talked to the BDCs, they are assuring us that as they do increase leverage, they want to make sure that they're underwriting at a higher level to mitigate any credit loss. So as the leverage increases, the returns would be higher, and they would be able to, we believe, maintain dividends. Also, we see more, as Boris had mentioned, ABL lending at higher rates. So as long as the asset quality stays high, we believe that the dividend coverage will maintain. and not only through the first lien loans, but also avoiding some of the covenant light and the adjusted EBITDA type of underwriting that is going on with the competition. So the main thing here is to keep credit quality high.
So there's another question coming through. Sorry. Will the BDCs continue? Sorry.
The bottom one. The question is, can you discuss further your thoughts on BDCs? Go ahead.
That have expanded away from cash flow lending into ABL, equipment, life sciences, etc. Boris,
Sure. So as we've discussed, the pool and ability to acquire new quality loans is diminishing. And given the availability of additional capital, the increased leverage is forcing a number of BDCs into niche assets such as ABL, equipment finance, and life sciences. Again, it comes down to the specialty, and as long as the BDCs have the necessary internal resources and the specialists to perform the necessary credit analysis, then we would get comfortable with the exposures building in the ABL market or any other niche segments.
If I may add, there are differences also amongst the ABL lending, basically because of the assets. So we, one of the things that we do is that we really look through all the investment portfolios of BDCs and look at exactly what they invest in, what kind of leverage they tolerate for their portfolio companies. And that's also true for analyzing the kinds of assets that they buy to use the ABL platform, because some of them think that actually performs much better. We have one other question. Are the BDCs worried about a decline in interest rates? Teri, you want to take that?
Right now, I would say that many are surprised, that we have had a reversal from the Fed to decline in rates. But given, 25 basis point decline, it's relatively immaterial to the BDCs right now. When we look at rates, we'd have to have a much more significant rate decline to affect earnings. As I had mentioned previously, 100 basis point decline would be between a 5% to 10% net interest margin. So BDCs are carefully looking at that and paying attention. But right now, with 25 to 50 basis points that the Fed is talking about, it's relatively immaterial. The more important thing to focus on right now is asset quality.
There's another question. Do you have a projection model to show the principal and interest payments we can expect to receive based on the existing portfolio to show that this can repay debt? Well, I think that's a very good question. One of the things that we do, as I said, we do model the underlying portfolios, underlying investment portfolios, both leverage their yield, because obviously that's really important for the BDC itself being able to pay their debt. It's not something that we can share with you, though, unfortunately, but we're happy to talk on individual name basis if you'd like to call us, and we can go into more detail. We try to talk about it as much as we can in our reports, but there's certain things that, because the BDCs provide private information on the companies that they invest in, we can't, put it in a model and send to people or put it in the report, but we can talk about it broadly and compare it to other names to give you some better color. Oh, and then another question, would you use as the average life on first and second unsecured debt?
Prepay assumption.
And prepay assumption.
I assume this is with regards to the unsecured debt issued by the BDCs. Again, it becomes challenging with the fact that BDCs, by regulatory requirements, are required to distribute up to 90% of their earnings. So the best way for them to repay any unsecured debt is to issue more unsecured debt and continually extend out the debt maturity. With that in mind, we always stress the importance of having access to a diversified source of funding and not just rely on credit facilities, but have access to either public baby bonds and private placements, as well as perhaps some element of preferred shares.
You know what? Maybe I just want to add a little bit to what Boris said, to just make sure that we understand the question correctly too. Because you're talking about the average. If you're talking about the average life of the loans, we obviously have visibility into those, and we look at them not really just based on averages, but each loan we look at the terms of the loan separately. The average life of the securities would have to do with our liquidity analysis of the debt of the company. So we have debt maturity stacks that we look at, just to clarify. And I think this is all the questions. I hand it back over to Caitlin.
We just wanted to thank
Close.
everybody for taking the time and dialing in. We hope you found today's presentation helpful. As always, KBRA strives to be the most responsive rating agency, so please feel free to contact any of the team with questions at any time. We're always happy to discuss. And if there are follow-up questions on the presentation, again, please don't hesitate to reach out. The slides are available for download off of the GoToWebinar, so please feel free to download those. And we hope everybody has a nice day. Thanks so much.